All right, this will be a walkthrough of a 15-year mortgage versus a 30-year mortgage. The examples that I'm using here are current mortgages being proposed in January of 2022. I'll say this, that the math always adds up. I mean, it adds up basically at virtually any time. The math will be very similar. So I'm not going to do two different properties and hypothetical interest rates. We're going to use this particular point in time just to teach the concepts and the entire conversation behind a 15-year mortgage versus a 30-year mortgage. So here we go. Let's start just to make sure to set the stage. This is a 30-year mortgage on a property here. We'll call it Arlington right here. And Arlington, we're going to get a loan on this property at $642,700 with a 2.63% interest rate. 2.63% interest rate here in 2022. The interest rates are still crazy low. That is a 15-year mortgage, 12 payments. There you have it. The payments are call it $43.23 per month. That's the payments, 15 years. You'll see that over here. And the total interest paid. Now this is the primary argument with, oh, you got to save interest on a 15-year mortgage. All right, so let's just remember that. $135,507 in interest payments over the course of a 15-year mortgage. Got it. All right, now, in contrast, remember, $43.23 per month and $135,500 in interest. Contrast that with a 30-year mortgage on the same property. Notice the interest rate, same loan amount, but the interest rate is higher. Now I forgot to change the number 15 over here, but what we're really looking for is, there's your loan payments, 360 payments, 30-year mortgage. The actual mortgage payment now, $27.97. And you'll see that reflected here, $27.97. Remember, the big selling point of a 15-year mortgage is, oh, you'll own your home half the time and you'll pay a lot less interest. That is actually accurate. You will pay less interest. In fact, $228,000 more interest on a 30-year mortgage. Now, if you stop right there, and that's as far as you get, it looks like a 15-year mortgage is just simply, easily the right choice. It saves you money in the long run. Now, there's one big thing I want to cover right now before I forget it, is this question of, how long will you stay in your house? How many people stay in their house for 30 years nowadays, especially in a home that perhaps might have been their family-raising home, where they've got a larger house, 2 stories, maybe it's on a big piece of land, maybe it's in an expensive piece of land. Are you really going to stay in your home for 30 years? So just think about that. That is rare these days. Most Americans move on average around 7 years. That's kind of a long time to be in a house. So keep that in mind. But this example is assuming 30 years. So let's compare 30-year mortgage to a 15-year mortgage. Let's look at all the details that I believe should be considered when you look at the two mortgages. Let's go side by side and let's bring up my comparison. Now, I have modified this comparison document over the years. I love to look at all the details, all right? So on this side over here is a 15-year mortgage, and on the other side is a 30-year. Now, we're going to get to that in just a second here, but what I want you to see in the middle is that I've brought some of the numbers over. That a 15-year mortgage payment is $43.24. There's the 30-year mortgage payment, and here's the big one. The 30-year mortgage payment is actually $1,527 a month lower than the 15-year mortgage. It is actually $1,527 a month less if you get a 30-year mortgage. So that's a big deal. Don't forget, The interest cost of a 30-year mortgage is $228,000 more. All right, now that we've got our numbers, here's my question. First question, can you pay a 15-year mortgage like a 30-year mortgage? If you had a problem where you lost your job, one of your children got sick, a family member, mom or dad, needed your help financially, something bad happened where money started getting tight, can you call the bank and say, hey, I'd like to take my 15-year mortgage, you know, that one with a $4,300 mortgage payment. Man, I would really love to pay $1,500 instead and just pay it like a 30-year mortgage. What does the bank say? No way. No way the bank is going to say that, right? Now, what are they going to tell you? They'll say, well, you know, if you want to do that, you'd have to refinance. Well, but I'm not really working as much, or I'm making less money. Then we may not approve your refinance, or we might have to jack up your interest rates, or the interest rate environment now is much, much higher. Bottom line is, you cannot change a 15-year mortgage with this high payment to a 30-year payment. You just have to keep paying the 15-year mortgage. You have to pay it, or you lose your house. That's just the way it is. My question then next is, if you could save that $1,500 delta between the two payments, what if you got a 30-year mortgage and you took the difference? You get a 30-year mortgage and invest the difference between the two payments, the delta. What if you invested the $1,527 per month and compare the numbers in the long run? Let's take a look. That's the piece that is often missed. The bank doesn't want you to look deeper because the bank makes more money faster on a 15-year mortgage. You think, well, wait a minute. They don't make more money because I'm paying them less interest. But they get to turn the money. The bank makes money turning that cash. And if you hold the cash in the walls of your house for 30 years, that's a long time for them to have to wait to turn that money again and to make more money. They will make more money in the banking system if they can get you into a 15-year mortgage. It benefits the bank. Go figure. So let's do an example, right? Let's run through the numbers. Let's say you recognize that there's safety, perhaps, in having a 30-year mortgage that you could pay like a 15-year mortgage if you wanted to, but if you needed to, you could go back to paying it like a 30-year mortgage. On the other hand, you look at it and say, well, if I just pay the 30-year mortgage, what would happen if I invested the $1,527 a month? Let's take a look. We'll take that $1,527 a month, and we've got the same house, by the way. The house is ours. You're living in the house. It's great. But you invest $1,500 per month, and I'm going to start off super conservative, and say if you could earn 3% over the next 30 years, investing the difference. You're still living in the same house. We're assuming you're going to be there for 30 years. Most people aren't. Let's just assume. So 30 years, 3%, that's $18,324 a year. Lo and behold, at the end of 30 years, that account is worth $875,000, and the house is paid off. The house is paid off, and you have $875,000 in your pocket. Okay? Let's talk about the house. The house itself, let's say, starts out in the Bay Area of California. Your basic 4-bedroom, 2-bath. Those of you listening on my podcast or listening here, watching on YouTube, you might be in Nebraska thinking, what the heck kind of a house is this? Is it a mansion? No, it's a 4-bedroom, 2-bath house in the Bay Area of northern central California. That's the price for a house in California. So let's say that house is worth $1.3 million today. And again, being very conservative. The house appreciates only 2% per year. I believe that's extremely conservative. Over the course of that 30 years, that house will grow in value to $2.3 million, a gain of $1,054,000. Now, stay with me, because we looked at getting a 30-year mortgage and investing the difference between a 15-year mortgage payment. What if you went ahead and got the 15-year mortgage, and after you pay off the house, okay, so over on the right-hand side, we're on this side now, starting in year 16, what if the house is paid off and now you take that $4,324 payment and do the same thing? What if you wait 15 years, in the 16th year you start investing the mortgage payment? All right? By the way, again, those of you listening on the podcast, there is a complete YouTube video to this. You can find me on YouTube, Kraig with a K, Strom, S-T-R-O-M, and then K-R-A-I-G. You can also search for the Income Engineer. Make sure that you subscribe and hit the little bell icon so that you get notifications when I upload videos. But this will be on YouTube as well. If you want to see the numbers that we're talking about, that I'm talking about here on this podcast episode, you got to watch it on YouTube. You can also find it on my Facebook and my LinkedIn. So now let's stay on track here. If you take that $4,300 mortgage payment that you were paying for 15 years, now you have a paid off house. Awesome. But we have a 30-year timeline we're trying to compare things to. So you invest $4,324 in the same conservative manner, 3%, and after 15 years you have $971,000. Now, whoa, wait a minute. Right there, you could stop and say, well, look at that, Kraig. Clearly, those numbers, you definitely are still better off having done a 15-year mortgage. Look at that. Yeah, maybe. Stay with me. Let's compare. The house does the same thing the house is going to do. This is an important distinction. The home you live in, or a rental property for that matter, only has one rate of return. The money that you have put inside that house earns exactly 0 rate of return. Nada. It earns nothing. Only the house itself has an appreciating rate of return. The cash that is used to hold the real estate, the money that you put in over 10, 15, 20, 30 years, that money in the real estate itself earns no rate of return. It is completely illiquid, no interest, no dividends. Only the house itself has an appreciation or depreciation rate. You could argue that the money tied up inside the house also has a bit of inflation risk because you're not doing something else with that money while it's in the house, but at least it's locking up a house. So in this example, the real estate is worth exactly what the real estate was going to be worth. Okay, so let's come down to the bottom in the middle and let's look at the numbers total. Let's look at the real estate plus the benefit of either investing the difference or investing after 15 years on the 15-year side. Right here, we're going to look at this number first. The 30-year mortgage total gain, right? Because you invested the difference up here, the total gain with the value of the real estate, $1.9 million. The 15-year mortgage right here had a $2,026,000 gain total. So it looks like in this example, sure enough, the 15-year mortgage has a $96,000 positive. That in this case, the 15-year mortgage came out ahead $96,000. Now, once again, I want you to think about this. What is the one thing that you can't do with a 15-year mortgage if you have an emergency? You cannot pay a 15-year mortgage like a 20. You can't pay it like a 30. You can only pay that sucker like a 15-year mortgage. So from a security point of view, is it worth the potential, the maybe possibility that you end up with $96,000 more after 30 years? Is it worth the risk of that first 15 years being locked into that mortgage? Most folks I talk to tend to think, I'd rather have a 30-year mortgage now that I've looked at the numbers, and I'll pay it like a 15, or I'll invest the difference. Now, I alluded to something earlier. I alluded to this idea of maybe the numbers are better, right? Maybe the 15-year mortgage is better. If you waited 15 years to start your investment process over here because you had to pay off the house, if you waited 15 years, is it possible that your tolerance for risk might be a little lower because you are now significantly closer to retirement? You've probably heard that as you get closer to retirement, you may want to dial back your investment risk. So if you wait 15 years before you start putting that mortgage payment now into the investment pool, is it possible that you may want to stay conservative with your investment? I would argue yes. I would suggest yes, be careful. On the other hand, if you started your investments in the beginning, over here on the 30-year example, what happens there? Could you perhaps take a little more risk because you have a much longer time horizon? Let's look at that. What if you had a slightly better rate of return? Instead of 3%, staying conservative, what if your rate of return was 4%? Oh, just a 1% difference, meaning the longer you have to be in that investment, perhaps you can absorb and take on a little higher risk, maybe over time, 1%. Well, what does that mean for the return? All of a sudden now, a 1% shift on the 30-year side of this equation, now the 30-year mortgage is $60,000 ahead of the 15-year mortgage. Now, I don't know what the numbers will be, and I won't go any higher than this, but this is just to prove the point. What if, over the long 30-year period of time, you could actually have a 5% rate of return? Again, I think that's a pretty moderate to conservative position. That is definitely a moderate place to be. What if your investment was at 5%? Well, lo and behold, now the 30-year mortgage is $250,000 ahead of the 15-year mortgage, and it came with the security of all of that liquidity in the early years. Keep that in mind. Instead of in the 15-year mortgage, over here on the 15-year mortgage, all of that liquidity is tied up in the walls of the house. It's tied up in the real estate itself. Whereas on the 30-year side, this ongoing investment builds up a very heavy liquidity that is completely outside of the real estate. In an emergency situation, could you just go get that money instead of asking a banker for permission to have your own money? There was a great line at one point from a financial advisor I learned from years ago who said, if you have to ask a banker for permission, it's not your money. Even though it's in the walls of your house, the only way to get it out is to sell the house or get a loan approved by a banker to pull equity out of that house. It's not your money. If it's sitting in the walls of the house, you can't use it. Yes, you can use the house, but you can't use the money that's in there. Okay? So as I go through this and looking at it, once again, this just reaffirms something that I've done the math on this dozens of times over the years, 26 years, and this proves a very fundamental, let me just say a fundamental point mathematically, that compound interest always beats amortized interest. You saw it happen just now, that if you have just a 1% move in the overall rate of return in that compounding account, it's massive. It's a huge shift. If you have a 2% move, it's an even bigger shift because compounding, again, is interest compounding on a larger and larger amount of money. Amortized interest is interest charged on a smaller and smaller and smaller amount of money. Compound interest always wins. It just works that way because it's math. All right? So, 30-year mortgage versus 15-year mortgage. Number one, personally, me as a financial planner and a paralegal at a great law firm, we start our conversations and our mindset with asset protection in mind and personal family financial protection in mind. So if you're in a situation, and I have seen it over the years, 2 decades, folks, I've seen it too many times, people being financially wrecked because they have obligations that are inflexible. They can't change those obligations and their financial world flips upside down and they're stuck in a 15-year mortgage, or they got giant credit card bills and they can't get out. A 15-year mortgage can never be paid like a 30. A 30-year mortgage could be paid like a 10-year mortgage. It can be paid like a 20-year mortgage. It can be paid like a 15-year mortgage. And you can always have the option to invest the difference so that that liquidity is separate and outside the walls of your house. Remember, you could pay the house off. When you look at the investment growth on the 30-year invest the difference plan, you could, in 15 years, theoretically, pay off the house if you wanted to. You could take all of that liquid cash and just pay off the mortgage. So now all of your liquid cash earning a rate of return is now inside your house. Pay off the house. You could do that. You just don't have that option with a 15-year mortgage because you got to keep paying it at the 15-year level. If you have questions about your retirement and retirement income planning, about your real estate, whatever it might be, send me an email, Kraig with a K at kraigstrom.com, KRAIGSTROM, Kraig at kraigstrom.com. I look forward to talking with you. Have a great one. We'll talk to you again soon. Bye.